Welcome to my presentation on how a 1031 exchange increases an investor's rate of return. My name is Pat O'Connor, and I am the owner of the Veritas Real Estate Group. The purpose of exchanging property is to defer paying capital gains tax indefinitely. This encourages real estate investment, helps individuals build a portfolio of properties in which they can benefit from multiple income streams, take depreciation on multiple properties, and claim multiple tax deductions. First of all, you must follow the IRS Section 1031 rules which govern exchanges. You cannot exchange a personal residence, only investment property. You must hold investment property longer than 1 year in order to qualify for the lower capital gains tax rate. You can invest profits in one or more like-kind properties. The investor may never personally handle the sale proceeds. And capital gains tax will be due when participating property is sold and not exchanged. Like-kind exchanges in the real estate world involve any type of real estate except the owner-occupied personal residences. So you can have an unattached single-family home and reinvest the sales proceeds into purchasing an office building and defer paying the capital gains tax for the single-family home. The same thing applies to vacant land, multifamily properties, retail stores, warehouses, any type of real estate except the owner-occupied primary residence are eligible. A third party must hold the proceeds of the sale. They will keep the money in an escrow account, and then this individual, who is called a qualified intermediary, will transfer the funds at the closing of the exchange property. Once again, the investor themselves may never possess the exchange funds. There are different types of exchanges. Simultaneous exchange is when the sale and purchase occur either on the same day or very close together in time. The delayed exchange is the most common, and this type of exchange, within 45 days after the closing, the investor must identify one or more replacement properties and 180 days to close on one or more. The list of identified properties is sent to the qualified intermediary. A reverse exchange occurs when the replacement property is purchased by the qualified intermediary before the relinquished property is sold. An improvement exchange is when the relinquished property is sold, the qualified intermediary purchased the replacement, the investor then makes improvements on this investment and purchases it from the qualified intermediary for a higher price than the qualified intermediary paid. And this allows the investor to shelter more of the proceeds of the relinquished property to benefit from the capital gains tax deferral. To summarize, a 1031 exchange allows investors to defer the payment of capital gains tax. In order to do this, they must use a qualified intermediary to hold the proceeds. If they're not paying capital gains tax, they have more discretionary income to build a portfolio of properties. Consult a CPA or real estate attorney for additional information, since the rules could change at any time. Thank you for your attention.